Welcome to Blue Nile Tutorials. In today's session, we're diving into our fifth chapter, Income from Employment Loans. Employer-provided loans can be a helpful benefit, but they also come with tax implications that are important to understand. We'll explore how these loans are treated for tax purposes, when they are taxable as a benefit in kind, and how to calculate any tax liability based on factors like interest rates and loan amounts. Whether you're navigating this as an employee or employer, this tutorial will guide you through the essentials. So, let's break it all down and simplify the taxation of employment-related loans. Let's get started. Welcome to this video on income from employment loans. In this session, we are looking at the situation where an employer loans money to an employee and either charges them no or a low rate of interest. If the employee is paying market rates of interest, there's no benefit to them. So this is a case of looking at cheap loans. Before we look at any detail, let's start with the rule about an exemption which applies to this benefit. If the value of the loan remains below £10,000 for the whole of the tax year, no benefit is calculated as it's exempt. This is primarily to allow employers to make loans to employees for things like season tickets for trains or the underground to get to work. Note though that if the value of the loan exceeds £10,000 at any point in the tax year, a benefit is calculated for the whole year, not just the period where the balance is greater than that limit. The calculation is in principle relatively straightforward, but there are some complex issues to look at. The formula is to take the loan value and calculate an interest charge using the official rate of interest given as 2.5%. This is another example of a benefit which applies those general principles, so we time portion if the loan doesn't exist for the whole tax year, and we can deduct any interest which the employee pays to the employer. The first question is how to calculate the loan value, and there are two potential methods to do this. The average method, or the precise or accurate method. The average method is a simple average loan balance calculated as the balance at the start of the tax year, or when it was first made if it's made mid-year, plus the balance at the end of the tax year or when it's repaid if that was done mid-year. And this is then divided by 2. Note that if the loan is made to the employee part of the way through the year, we don't use an opening balance of nil, but instead the initial advance made, and similarly, if it's repaid within the year, we take the final balance just before the loan settled and not a balance of nil. The other method for calculating the loan balance is the accurate method, which is more similar in nature to how a normal financial lender would calculate interest charges. For this method, we calculate the balance of the loan at the end of each month and charge interest at a monthly equivalent rate for that month. First, let's consider Tess. Tess is provided with a loan by her employer of £40,000 on the 1st of January 2017. Just one repayment has been made by Tess at £10,000 on the 1st of January 2018. Tess has paid no interest to her employer. To calculate the benefit for the 2017-18 year, we therefore need to first calculate the loan values on which to charge interest. Using the average method, the balance on the loan at the start of 2017-18 is £40,000, which has reduced to £30,000 when we get to the end of the tax year. Adding these and dividing by 2 gives us an average loan balance of £35,000 on which interest would be charged at 2.5%, so £875. If we rework this using the accurate method, the calculation would be to take the £40,000 loan balance at the end of the months of April to December, so 9 months in total, and then the reduced balance of £30,000 at the end of the months of January to March, so 3 months, and then charge interest accordingly. So for April to December, we'd have 40,000 multiplied by 2.5% multiplied by 9/12, so £750. For January to March, we'd have £30,000 multiplied by 2.5% multiplied by 3/12, so £187.50, giving a total benefit then of £937.50. Once we have both calculations, we need to decide which of these should be taken to be the benefit to include in the employment income. Questions will often tell you which method to use, but if not, take whichever results in the lower figure. So here we would take the benefit to be £875. Now let's consider a slightly different example. Bob was loaned £120,000 by his employer on the 1st of May 2017. He made a repayment of £50,000 on the 1st of August 2017, and then repaid the rest of the loan on the 1st of January 2018. This time, let's just calculate the benefit for 2017-18 using the average method to show you how this one is different. At the start of 2017-18 tax year, there's no loan balance, but rather than using nil in the calculation, we take the loan value when first made of £120,000. And again at the end of 2017-18, there's no loan balance, but instead of using nil in the calculation, we take the final balance on the loan immediately before it's clear, of £70,000. The average loan balance is therefore £120,000 plus £70,000 divided by 2. Again, we use the same 2.5% interest rate, but this would give us a benefit for the whole tax year, when this loan only exists between the 1st of May 2017 and the 1st of January 2018. We therefore need to time apportion the charge to show what it is for these 8 months. So 95,000 multiplied by 2.5% multiplied by 8/12 gives you £1,583.